Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good afternoon. Is it afternoon? We got FOMC coming out here 5 minutes from now. And yeah, it's going to be fun, I think. Well, I don't actually think it's going to be fun. So a couple of things. First of all, I'm not going to... I might take a trade on a sim account here in the 10-year. But I'm not going to try taking a discretionary trade on the combine. I just don't, been off of, yesterday and I'm still recovering. And, I don't really see a lot of opportunity in today's statements. So I'm not sure that, like, prepping up for taking a big risk here is really appropriate in this case. Now, with all that said, there is a possibility. There is like a big tail risk here. So if they come out and they're hawkish for some reason, which I really highly doubt, but if they did come out and it was more hawkish than expected, the market is not very well protected against that. And I think we could see some excessive downside, especially if they were able to get below like 43.30 or so. On the S&P 500. So that's kind of what we're looking at. Another thing is I have, a job and an important work meeting to get to. So I'm not going to be able to stream the whole press conference, unfortunately. But we'll watch the first 30 minutes together. That's the best I can do, unfortunately. Anyways. So you got that. I got to get myself into Federal Reserve mode. I was watching this video. So I've been watching, when we were talking about the He-Man thing the other day, I was like, I thought it was okay. And there were some things that I thought they smashed out of the park. But I bet you, like, maybe people that actually watched He-Man as kids maybe have different opinions about it. The internet hates it. The internet absolutely hates it. So, like, I have that going through my head. Because I'm not sure I agree with what the internet is saying about it. But no, we got to talk about the Federal Reserve. Is the inflation transitory? What's Powell going to say? Oh, you know what? Do we still have messages? Oh, we do. Okay, cool. We'll turn the robot on here. And I will get out the tweet decker. Complex adaptive systems and how to beat them. Oh, I would like to click this link. Okay, yes. Well, that's interesting. That Kyle posted a link there. I gotta go. This guy has a ton of subs. Huh. Okay, well, we can make sure we got everything right here on the Twitters. Nope. Okay. So we got 1 minute to go here. So we're going to want to see the statement. We're going to see what changed in the statement. Hey, they definitely pulling. Look at that. Interesting though that must be because I got CQG on this chart, huh? I feel the anticipation. Oh, the E-mini is moving, but okay, now the treasuries are moving. I'm going to turn that off so that you guys don't have to hear it, the siren every 5 seconds. So this is a pretty aggressive move here on the downside, though. I'm wondering what it is that they're looking in here. I'm still waiting for the, comparison and changes. Okay, here's the comparison. Let's look at this. Oops. Okay. Sectors most adversely affected by the pandemic have shown improvement, but have not fully recovered, blah, blah, blah. Path of the economy continues to depend instead of will depend significantly. Last December, the committee indicated it would continue to hold increase its holdings of securities. Since then, the economy has made progress towards these goals, and the committee will continue to assess progress in coming meetings. And that is like the only real change. I should have bought that one. Look at it come back. So far, I don't see anything significant in here, and I'm a little confused as to why they moved down the way that they did, because they typically do that because they actually see something, but maybe it really was just volatility, right? Yes, it says good to have you. Hey, thank you very much. I was really tempted to just click market sell in there, but that would have been the wrong call, right? Might be able to get one right here. Yeah, was too slow. Oh. Okay, they're gonna be like that, huh? I was like, hey, maybe I could buy 07.5 and tick down. I don't know, I was thinking maybe putting it down in there. And then it went 2-3 ticks all at once. It's like, okay. A little bit of flattening going on here. And this 210 steepening. The dollar rising. Oh, I need to get that up here. Look at that. The dollar just taking off of that. Okay, so the E-mini recovered its initial drive down, and now it's already come out off the top. So I would say that the S&P 500 in particular seems to be moving quite a lot, all things considered. Yeah, they're still doing this skippy skip stuff. The 5-year goes down 2 ticks and then drags the 10 with it. Probably because of the flattener they've got going on there. Gold is taking a beating here. 6J is getting hit. Oil unchanged. What about so like corn, soybeans, none of these? No. Coppa's down today. Does not look good for silver and gold. Oh, we should turn this on. There you go. Now you can really see what's going on, right? You can see the volume definitely coming into the 5-year there. New York Fed to conduct overnight repo operations with the minimum bid rate of 0.25 and with an aggregate operation limit of 500 billion. That's different, right? Does that mean that we can no longer have $1 trillion parked at the Fed every night? What do you think this means? Some people saying here progress being made, but not quote unquote substantial further progress that the FOMC / Powell craves. Well, I think that might justify a refresh here. They went and stopped out the longs in the treasuries. Sort of like almost perfect, and then right back up. Same in the E-mini, actually. All right, now it's steepening back out a little bit again. The 30 is, that's really weird. That's really weird. I'm curious to see that the ZC has unusual relative volume, but that must just be an overall thing in that market. I don't think it's related to the FOMC at all or anything like that. Also, looks like the euro moved more than the Japanese yen off of this. That's curious to me too. Sorry about background noise, by the way. You know, kids are all home right now, so normally it's quiet in the morning, huh? Ah, there's a little bit higher. The E-mini going to turn around and turn this into a good thing? Maybe it would have been worth a try and it hit at 10. Actually, sure. Try it. Okay. Good. You can't hear anything? You can hear me though, right? I don't have anything else going right now. I don't have, like, the press conference hasn't started yet. Oh, you're saying you can't hear anything about I was complaining. Yeah, well, when I look at my volume meter, I can see it going up, but I guess it's not enough that you can hear it in the back. Yeah. Okay. I got you. Dude, I'm really happy about that one tick scalp. I mean, I think there was a lot of luck involved in that, but it was a pretty good call. It was fast. Like, when it's really fast, I get filled and then almost immediately they hit back into the other side. That's like, I got it right. Here, it might even make sense to try and do buys again, but oh, actually, I guess that was too far. Look at that. There was a lot of pulling on that move, though. Oh, and you know what's going on? Oh, maybe not. I'm just now realizing that the dollar came back a lot, so. Biden is talking right now. Biden says it looks like lawmakers have reached a bipartisan agreement on infrastructure. And News Squawk was tweeting, "Stop it, Joe. We're in the middle of FOMC. We don't need to concentrate on you too." Funny how I don't know. It's usually when we're doing the live stream for FOMC, it can be a different group of people sometimes. And, I would expect there to be less people interested in watching it this time around because there wasn't really any big issues or anything that people were expecting, they're kind of expecting it to be a non-event. And so far, I'd have to say that it seems like that's what's happening, is that it's a non-event and the yields are, still within the day's range, essentially, after that initial overreaction. Live Action asks infrastructure deal or amnesty. I think that they're talking about infrastructure. I don't think that amnesty became a part of that bill in the end. What do you think? Will the Great British Pound and the JPY go buy or sell? Well, the pretty much everything fell against the dollar, but it looks like they're recovering their losses. They're coming back to unchanged. And I don't see anything in this FOMC statement that so far should really have a significant impact on the balance of trade or currency flows or anything like that. The one thing I do see that might make a difference here is it does sound like they made some changes to the repo facilities and so forth. So there might be some short-term impacts on, well, not short-term, there might be some impacts on the short-term rates, rather. I don't have those up, unfortunately, but that's going to be something that when I get back to the end of the day, I'm going to want to take a look at, because it looks like I've seen a note here in Twitter, but nobody's talking about it. But it suggests to me that they did change something, that not as many people can. There's a limit on how much money can use the repo facility. So I'm gonna want to hear what the experts say about that. But, everything just kind of looks like a non-event move now. Now, the treasuries are kind of moving back down. So the issue here is the tail risk is that they say something hawkish, the interest rates rise, and it hurts the S&P 500 here. Right now, the S&P 500 is buying back up, but the rates are increasing too. So Mastermind says, thanks, dude. Well, I'm just telling you what happened. Still got about 8 minutes before the FOMC meeting starts. So I'm thinking that this is going to be one where you could probably really screw yourself trading it, right? So I caught that one little good scalp. I wish I had gotten the other one, the earlier one. So far, since then, I haven't really seen like a really, really clear spot. Maybe here at 8. Maybe could get away with that. Let's just assume that we got filled with that 1466 going in. Would we get filled in the 8.5? Yes, you would. Okay. So that one would have been good too. We could call it 3 for 3 if I was fast. But I don't really want to take trades here too close. Okay, now News Squawk says their analysis is small tweaks to the Fed statement suggest Jackson Hole taper signal likely ahead or possible September official announcement. I'm going to read their more detailed thing. The FOMC left rates unchanged as expected, and there weren't many wholesale changes to the statement. However, there were 2 new additions. The Fed acknowledges that the economy has made progress towards these goals, and the committee will continue to assess progress in the coming meetings. But if the Fed does not appear to think that the substantial further progress threshold has been met, noting that the sectors most adversely affected by the pandemic have shown improvement but have not fully recovered. The recent Delta concerns by market participants do not seem to be reflected in any statement language change, and therefore this should support the expectation that the Fed will likely make an explicit taper is coming signal at the Jackson Hole Symposium at the end of August, followed by an announcement in Q4 before implementing the scaling back of asset purchases by early 22. That is awfully speculative for them to be saying that. If I was them, I would not be making that kind of analysis. Like, that they didn't get into really speculative opinions about the virus here that people have only started to talk about over the last week, and that they didn't say anything about that means that they're going to taper, I think is like really okay. On the health crisis, the Fed removed the line that sectors affected by the pandemic remain weak but have shown improvement, replacing that with sectors most affected by the pandemic have shown improvement but have not fully recovered, which suggests that the recent Delta variant fears have not forced the Fed to revise its outlook for growth lower just yet. Elsewhere, the Fed finally launched its standing repo facility, as has been heavily alluded to, but will likely not be used until money market rates begin rising towards the top end of the federal funds target range. The Fed is facing the opposite problem currently with the surge in the reverse repo facility. Oh, right, okay, I understand now. So they're saying for the repo, it's going to be 5% and max of 500 billion, but that has nothing to do with the reverse repo. That's not a change. Okay. Christian Sienma does not support the Democrats' 3.5 trillion bill, but cinches bipartisan infrastructure deal, which is what I expected to happen. I'm actually a little surprised that they're saying this now. That's going to matter, as if we didn't have enough things to worry about. Well, that's good. That's dovish, really. That's dovish for treasuries here. The mini seems to have calmed down a bit. Coleman asks, what data feeding broker do you use? So at the moment, I am using both, actually. No, I have a NinjaTrader brokerage account, and I'm using CQG. But normally I use Rhythmic. I like that you can plug multiple applications through Rhythmic Trader Pro, so that I can get my data in NinjaTrader and Jigsaw Day Trader. And like if I close NinjaTrader or NinjaTrader crashes, it won't affect my data in Jigsaw. So I prefer that. But right now, they're not letting me switch over until they've like completed becoming an FXCM or whatever. So I'm on CQG data. But I'm also running a combine, a sponsored combine, and that runs on Rhythmic data. The robot's not turned on right now, though. What you see on the screen is CQG. So, for instance, you'd notice that ahead of the thing, it was only showing like the 10 levels or whatever, because that's all that they show you. See, I have like 100 depth levels. I have it set to show me 100 depth levels, but it was only showing me 10. And beyond the 10, it was showing the old numbers. And even down in here, like at 30, that's not what it is anymore. So that's CQG. What the hell? Dude loses 42K shorting Bitcoin. Guy had just 25K in his savings, so he took out a 25K high interest rate loan for the short. He says he hopes it keeps going up so that every other bear that talked him into this can also get screwed. Oh my gosh. Bitcoin did move a little bit here. I think we could say moved a little bit. $500. Okay, here we go. Oh, look at that. They put somebody on the soundboard. It was too hot. He fixed it. They're already approving upon last meeting. Good job, boys. You know what else? Powell's tie is a little bit straighter. It's still a little. We'll close him. You don't need to hear it twice. See his tie here? What's with this? What's with that? I exaggerated it there, but we could do a little bit of work on the type. Overall, I think that the suit looks great. Oh, did you see that big old fatty 7K that got stacked at 07.5 for a second? Looks a bit sloppy, actually. Yeah, it really is. So far, it doesn't look like that anybody's making big bets off of this, and that the movement that we're having is just the result of low liquidity. Oh, you know, you can't even hear what he's saying here.
How quickly
Didn't turn off the
respond
right
in the
one.
near term. These bottleneck effects
Now
have
you
been
can hear him.
larger than anticipated, but as these transitory supply effects abate, inflation is expected to drop back toward our longer run goal. Very low readings from early in the pandemic, as well as the pass-through of past increases in oil prices to consumer energy prices, also contribute to the increase, although these base effects and energy effects are receding. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal.
And now I'm seeing some of the news squawks picking up on Sienna saying that she's not going to support the $3.5 trillion budget deal.
If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of policy.
Mm-hmm.
The effects of the pandemic on the economy have continued to diminish, but risks to the economic outlook remain. Progress on vaccinations has limited the spread of COVID-19. However, the pace of vaccinations has slowed, and the Delta strain of the virus is spreading quickly in some areas. Continued progress on vaccinations would support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices.
The 10-year really fell out there. What's
along
going
with our
on?
responsibilities to promote the
Is the
stability
dollar
of the
moving as
financial
this
system.
happens? Dollar is moving up.
As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored
Look at that
2%.
sweep of
We
orders that
expect
came
to
through in the
maintain an
5.
accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect
If
that
he
it will be
wasn't talking
appropriate to
right now,
maintain
I
the
would
current
maybe try
0
a
to
short here in the
1.25%
10,
target
but
range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment.
well, I guess it's
And
coming
inflation
back
has
up,
risen to
so
2% and is on track to
wouldn't have taken
moderately
it.
exceed 2% for some time. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month and of agency MBS by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition once economic
5-year
conditions
hitting
warrant
back
a
hard.
change.
Look at that.
Participants expect that the economy will continue to move toward our standard of substantial
Okay.
further progress.
And the dollar coming back
In coming
down.
meetings, the committee will again assess the economy's progress toward our goals.
Gold is a
and the
lot more
timing of any
mixed
change
than it
in the
was.
pace of our asset purchases will depend on the incoming data. As we've said, we will provide advance notice before making any changes to our purchases. On a final note, we announced the establishment of 2 standing repo facilities, a domestic one for primary dealers and additional banks, and another for foreign and international monetary authorities. These facilities will serve as backstops in money markets to support the effective implementation of monetary policy and smooth market functioning. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Thank you. Let's go to Steve Leisman with CNBC.
Thank you very much. Mr. Chairman, I wonder if you might be able to put some, I don't know, numbers or maybe more detail around this concept of substantial further progress. What counts as the progress numerically, if you will, or citing data, if you could, that you cited in the statement today? And if you could be more specific about what substantial further progress would look like, and if that would then lead you to an announcement of an actual reduction in the purchases of your assets. Thank you.
Great, thank you. So, more detail on substantial further progress. So, let's talk about the maximum employment part of that. As you know, with maximum employment, unlike with price stability, where we can target a number 2% on average, with maximum employment, there isn't a single number that we can target. We monitor a broad range of data about different aspects of the labor market. There's unemployment among different age groups and such. There's participation, there's wages, there's all kinds of flow data, and we look at all of it to try to arrive at a picture of what is maximum employment. So there isn't, I can't give you a set of numbers, for example, a numerical threshold like we used for a time back in 2012, I guess it was.
I think that the market likes that he's being
What we said
invasive
was
about setting a
substantial
specific
further progress
target.
toward our
See the
goals.
treasuries
What we
moving
said
up
was
like
we
that?
would keep, effectively, we would give advance warning as we and more and more clarity as we move forward. And that's what we're going to try to do. So, what would substantial further progress be? I'd say we have some ground to cover on the labor market side. I think we're
Newsquack
some
says,
way
"Nice
away
try,
from,
Steve," but we all knew he
from
wouldn't
having
bite on
had
that one.
substantial further
Yeah.
progress with with toward the maximum employment goal. I would want to see some strong job numbers, and that's kind of the idea.
If I could follow up, you talked about one side of the equation. You didn't. Does it mean you feel like you've reached your goal when it comes to the inflation side? Thank you.
So inflation is running well above our 2% objective and has been for a few months, and is expected to run up certainly above our objective for a few months before we believe it'll move back down toward our objective. The question whether we've met that objective formally is really one for the committee to make. I can't do that by myself. But it's clear that at this time, inflation is actually running above 2%, and again, has been and will be, at least we expect it will, in coming months before returning down toward our target.
Thank you. And Saphir with Reuters.
Hello, can you hear me?
Yes, we can hear you.
Hello, can you hear me? I'm sorry.
Yes.
Yeah,
yes,
you're
we can
gonna
hear you.
wait too long for.
To follow up on the question, I want to ask, is it correct to see this as the start of the advance notice process, before a taper, and also, can you speak to how the recent surge in COVID factors?
Forex Live says it sounds like there are some strong differences of opinion
paper
regarding the inflation outlook at the FOMC. It's probably,
so as you know, we're in a process now.
It probably is why he said what he said there, where it's like,
that,
I can't say that's up to the committee to decide.
At this meeting and in coming meetings, we're going to be continuing to assess the economy's
I think the argument
progress
about how
toward our
transitory
goals,
this is actually
and give
going to be
advance notice.
is
We'll
just
try
as
to
hot
provide
there at the
additional clarity about our
at
thinking,
the Federal Reserve as it is
both
everywhere
in
else.
the post-meeting statement and in the minutes and in the public comments that people make. Our approach here has been to be as transparent as we can. We have not reached substantial further progress yet, so we're not there, and we see ourselves as having some ground to cover to get there. So
Some ground,
that's
huh?
what I would say. In terms of COVID and the Delta strain, I'll say a couple things. Of course, it will have significant health consequences for many, and we need to keep that in mind before we start. Before we mention and move to the economic questions. This is rising cases in a number of parts of the country, and some forecasts are for them to rise quite significantly. We'll see. What we've seen, though, is with successive waves of COVID over the past year and some months now, there has tended to be less in the way of economic implications from each wave, and we will see whether that is the case with the Delta variety. But it's certainly a.
So perhaps that's why they didn't make any mention of it in the
expectation.
statement, even though some people expected maybe that they would, because of the recent concerns about the Delta variant, is because
of the risk of
from
infection,
what we've seen so
dining
far,
out,
the
traveling, schools
economic
some
impact of
schools
it
might
shouldn't be
not
as much.
reopen. We may see economic effects from some of that, or it might weigh on
That
the
certainly
return to the
wouldn't
labor market. Some people might
change
choose.
if there
Again,
were shutdowns so
we
hot.
don't have a strong sense of how that might work out, so we'll just be monitoring it carefully.
Thank you. We'll go to Nick Timros at the Wall Street Journal.
Hi, Chair Powell. Nick Timros at the Wall Street Journal. In your opening statements in March and April, you noted that a transitory rise in inflation above 2% this year would not meet the threshold of moderately exceeding 2% for some time. And I noticed you didn't repeat that qualification last month or today. And so in your view, has the rise in inflation this year met the threshold of moderately exceeding 2% for some time?
That would
Didn't they
again
already
be a
ask that question?
for the committee, but I would really say the guidance that you're talking about is really the guidance to do with liftoff.
Imagine being a reporter.
We had to have
You get
labor
to
market
ask the
conditions
Federal
consistent
Reserve
with full
Chairman a
employment,
question,
inflation
and you ask
at
him a
2%
question that
and on
somebody
track to
already
run
asked.
moderately above 2% for some time. It really isn't relevant now. Because we're looking at tapering asset purchases. We're clearly a ways away from considering raising interest rates. It's not something that is on our radar screen right now. So when we get to that question, when we start to get to the question of liftoff, which we are not at all at now or near now, that's when we'll ask that question. that is when that will become a real question for us.
Great, thank you. Gina Smialek at the New York Times.
To the question we were asking earlier today, that would would the Federal Reserve be down with like a shutdown and everything? Well, I guess we don't know, but kind of what I'm seeing, what I'm hearing just from here, kind of suggests that they don't think that there's any reason that there should be a problem, and they would start asking questions if we like shut things down again.
Say that again. I apologize.
Oh, yeah, no, sorry. So I was wondering if you could talk a little bit about how the divergence in global growth and the sort of multi-speed recovery we're seeing around the world impacts how the Fed thinks about its policies. So do you take into account that sort of multi-speed recovery when you're thinking about tapering QE, and do you take it into account when you're thinking about liftoff?
Thanks. So it's an important feature of this recovery is how uneven it is, and in many cases it's related to the fact that some countries have had little in the way of access to vaccines, and so they're seeing significant outbreaks, and it's weighing on economic activity, whereas other countries, such as the United States in particular, are having a very strong rebound. And now Europe is having a stronger rebound as well. So it's a feature of our economy. Now, how does it affect our policy? In a couple of ways, potentially. One just is that, in general, economies and through financial markets and through trade are deeply interconnected now. And so a stronger global economy will lead to more U.S. exports, and that'll help economic activity. To the extent the global economy is weak and the United States is strong, we'll wind up exporting some of our demand through imports rather than having a lot of exports. And that's one way.
Newsquag is just tweeting, "So we're done. What more can he add today?" Don't jinx it.
Loose out there. As long as there's time and space for the development of new strains, no one's really finally safe. These strains, there's no reason they just can't keep coming, and one more powerful than the next. We don't know that, but that's certainly a plausible outcome. Now, as vaccinations rise, we can nonetheless get back to our economic activity. But it is both the right thing to do and very much in our interest to make sure that vaccination happens broadly around the world, just for that reason.
Thank you. James at the FT.
Thank you very much. Chair Powell, how would you describe the risk to the outlook on inflation at the moment after the last data came out higher than expected? Do you believe the risks are tilted to the upside? And does the committee share that view, or are they in balance? Are you still worried that there could be a hit to demand from the Delta variant that could tilt them sort of to the downside again? If you could give us a sense of that, that would be very helpful.
Sure, I'd be glad to. So if you look at the most recent inflation report, what you see is that it came in significantly higher than expected, but essentially all of the overshoot can be tied to a handful of categories. It isn't the kind of inflation that's spread broadly across the economy. It's
that's not
new,
true.
used, and rental cars, it's airplane tickets, it's hotels, and it's a couple of other things. And each of those has a story attached to it.
Every category was high. Yeah, there were some that were really high, but every category was high in the last report.
Those are temporary things because the supply side will respond, the economy will adapt. We have a very adaptable, flexible economy and labor market, and it's a real asset that we have. And so we think that inflation should move down over time. Now, we don't have much confidence, let's say, in the timing of that or the size of the effects in the near term.
They don't have much confidence in the timing of that.
That the risks to inflation are probably to the upside.
Yeah. Because how long are these effects going to be in place? For sure.
In the medium term, that inflation will move back down. Again, it's hard to say.
I have to say, though, there's this push to say that the inflation is not that high and that it's just a few outliers. And that was true of 2 reports ago, but last report, that was not the case. Every category was high, and people need to understand that the inflation was higher than expected. That doesn't mean that it will be like that next month.
Particularly if inflation expectations were to move up, we would use our tools to guide inflation back down to 2%. So we won't have an extended period of high inflation. We think that some of it will fall away naturally as the process of reopening the economy moves through, and it could take some time. In any case, we will use our tools over time as appropriate to make sure that we do have inflation that averages 2% over time.
Thank you. Victoria.
Bitcoin moving back up to 40K here, by the way.
Hi, Mr. Chairman.
Which doesn't make much sense at all because the rates have increased.
Investors think the Fed might eventually over-tighten. So my question is, do you think that markets have bought into the central bank's new framework, and how do you balance that with managing inflation concerns?
Well, so in terms of what's been happening in bond markets, I don't think there's a real consensus on what explains the moves between the last meeting and this meeting.
That's right.
We've seen the long-term yields go down significantly. Some of it is a fall in real yields, which may have been connected to, some speculate, connected to sentiment around the spread of the Delta variant and concern about growth. There was also some decline in inflation and compensation, which is significantly reversed. And there are also so-called technical factors, which is where you put things that you can't quite explain. So I don't see in any of that there is really anything that challenges the credibility of our framework, if that's really your question. We are committed to achieving 2% average inflation over time. What we said was that, in particular, when we see a very strong labor market, high levels of employment, low levels of unemployment.
I'm a little concerned that he's saying, well, maybe the bond market is making some bets about the spread of the Delta variant, but then we, the Federal Reserve, don't actually have to do anything because we don't expect it to be a thing.
Before the pandemic, so we're a ways away from full maximum employment.
One of those two things is going to be wrong, right?
So it's kind of the opposite case, and we have to deal with that. Any central bank has to deal with that by looking at the inflation and asking whether it is broad-based and likely to be persistent, and whether inflation
Powell's
expectations
on bond market price action is in sync with the consensus explanation.
So we're monitoring that very carefully.
We don't know,
and we're prepared to use our tools as appropriate. But again, I think our framework is pretty well understood, and I think the real test of it will be down the road when it's time to think about raising interest rates. And how we assess that set of issues.
Thank you. We'll go to Rich at Bloomberg.
Thanks very much, Michelle. Chairman Powell, you just alluded to the fact that you're prepared to use your tools to slow the economy down.
Richard, we need to work on your setup here.
Inflation looks like it's getting out of control. I want to just try to understand that in the context of the framework.
The room looks okay. But you're only showing up in like the bottom half of the screen, and you're like hunched over, and like we can work on this. We can work on this.
Does it also mean you'd be prepared to raise interest rates, even if you are still buying assets? Thank you.
So there's a part in our statement on longer run goals and monetary policy strategy, which, Rich, I'm sure you're familiar with, which talks about that case in which the two goals are in tension. Most of the time, if you have high inflation, you also have high employment. They tend to go together. This is a situation where they're temporarily in different directions. We're not at full employment, but we are having high inflation. We feel like we're going to be making good progress over the course of the next couple of years, really, toward maximum employment. This is a very strong labor market.
So you mean he's turning in their treasurers are responding here?
Compared to the number of unemployed, we're clearly on a path to a very strong labor market with high participation, low unemployment, high employment, wages moving up across the spectrum. That's the path that we're on, and it shouldn't take that long in macroeconomic time to get there.
Shouldn't take that long.
So that's what I think it is really the likely case. Again, it's not timely for us to be thinking about raising interest rates right now. What we're doing is we're looking at our asset purchases and judging what is right for the economy and judging how close we are to substantial further progress, and then tapering after that. And the question you ask about would we raise rates if we hadn't finished the taper, hypothetical question. We'd face the circumstance at the time. We could always just, one thing one could do would be to just cut asset purchases all the way to zero if you wanted to do that. But it's just hard. It's hard to answer what you would do without knowing a lot more about the situation. Ideally, you wouldn't be still buying assets and raising rates.
He's saying,
because,
like,
of course,
if it was
you're adding
necessary, they could just
accommodation by
cut asset purchases
and
to
removing
zero.
Accommodation by raising rates. So
That is
wouldn't
good
be
to know.
ideal. I'll say that.
Like, if things came out and
Thank you.
like
We'll go to
inflation
Edward
was
Lawrence at
just
Fox
out of
Business.
control, they could just
So
cut
thank
the
you, Mr.
asset
Chairman. Thank you, Mr.
purchases
Chairman, for
just
taking the question.
outright
You're
all at
talking about
once,
jobs. You just said they were on a path to a very strong
and
job market.
maybe raise rates,
we
maybe
have
even.
9.5 million people unemployed as of the last labor market survey, and 9.2
Okay, we'll listen to
million
Ed
job
here, and then I
openings.
got to get going.
So what's the disconnect? Is it a skills gap? Is it the extended unemployment benefits? Is it the fact that people just aren't willing to relocate? What is the disconnect there?
It's a really unusual situation to have the ratio of vacancies to unemployed be this high, and we think there are a number of things at work there. Maybe the place to start is just to say that this is now not so much about people going back to their old jobs, it's about finding a new job. So that's a time-intensive, labor-intensive process, and there may be a bit of a speed limit on that. There's research that suggests that there is a speed limit on that. So it's not like you can have millions of people at the beginning of the recovery going back in a single month because they're just going back to their old job. This is about job selection, things like that. There may also be some factors that are holding people back, and this is what surveys say. There are people who are reluctant to go back to work because they still feel exposed to COVID. These could be jobs where there's a lot of interaction with the public, and where perhaps there's a family member who's vulnerable or for whatever reason. There's also caretakers who are where schools are not fully open and parents are at home. Or taking care of older people. And there's also been very generous unemployment benefits, which are now rolling off. They'll be fully rolled off in a couple of months. And all of those factors should wane. And we think we should see, because of that, we should see strong job creation moving forward. I mean, ultimately, it's unusual to see aspects like the job openings number in a context where there are that many unemployed people. That many job openings would typically suggest a tight labor market. And of course, we hear from businesses all over the country that it's very hard to hire people. And that may be because people are shopping carefully for their next job. I mean, I think the bottom line on this is people want to work. If you look at where labor force participation can get, people will go back to work unless they retire. Some people will retire, but generally speaking, Americans want to work, and they'll find their way into the jobs that they want. It may take some time, though.
Okay, well, so it's time for me to get going now. But I think we learned a couple of interesting things there. But I don't see anything that should really move the markets a ton. So, yeah. I will just paste in here, guys, in the chat in case you were just listening to me and you don't know where to go. That's the Federal Reserve's live stream. So, I will see you guys. We can continue. We'll have lots to talk about tomorrow, I think. So I'll see you guys tomorrow. And in the meantime, you stay profitable, friends. Profitable.